Welcome to the chip market, where we help you invest smarter in the world of chips. Today, we're digging into TSMC's absolutely phenomenal $32.5 billion quarter. You know, these results, they're signaling a massive structural shift in the company's entire business, and it's a shift driven completely by the AI revolution. We're going to examine the forces behind this explosive growth and figure out what it all means for TSMC's dominance over the next few years.
So, the headline numbers look incredible, right? But the critical question for any investor is this durable? Is this just a one-off sugar high from the first big AI build-out? Or are we witnessing the start of a sustained, multi-year supercycle? Our entire analysis today is going to be framed around answering that one central question.
So to get to that answer, we're going to do a methodical investigation. We'll start by deconstructing the quarter itself. Then we'll dig into the real engine driving these numbers, which is AI and advanced packaging. From there, we'll look at how this is basically rewriting TSMC's financial model and its tech roadmap all the way through 2028. And then, of course, we'll take a balanced look at the risks that could break this whole thesis. All right, let's get into the numbers.
Okay, first things first, let's just establish the hard facts of this quarter's performance. We need to understand exactly what these headline numbers are telling us before we can really analyze what's going on behind the scenes. So for the third quarter of 2025, TSMC posted a staggering revenue of nearly 990 billion new Taiwan dollars. Now that translates to roughly 32.5 billion US dollars for a single quarter. This number didn't just meet expectations, it solidly beat analyst consensus and landed right within the company's own very ambitious guidance. Now, it's really important to clarify one point here that tripped up a few people. You might have seen a headline number of 331 billion and thought, wait, was the quarter a miss? No. That was just the number for the month of September alone. The full third quarter figure, which covers July all the way through September, was nearly 3 times that amount. That shows just how powerful and sustained the momentum was across the entire period.
And check this out. This performance represents a massive 30.3% year-over-year growth. What makes that so impressive is that it's building on an already high base from last year. So this isn't some recovery from a low point. This is a powerful, real acceleration in demand that TSMC is seeing right now.
Okay, now, this slide. This is arguably the most important slide for understanding the new TSMC. Just look at this revenue mix. For the first time ever, high-performance computing, or HPC, which, let's be honest, is now almost entirely a proxy for AI accelerators, has become the dominant force at a staggering 60%. The smartphone segment, which for years was the main engine for TSMC, has dropped to just 27%. This isn't just a cyclical change. This is a fundamental structural pivot from a consumer-centric business to a data center-driven one. So we know what happened, but the really critical question for any of us as investors is why? This wasn't just some broad recovery across the board. No, it was driven by very specific, very powerful forces in AI and advanced packaging. So let's pop the hood and take a look. The outperformance was fueled almost entirely by an explosion in demand for AI chips. We're talking about a tidal wave of orders from key customers. Take Nvidia, for instance. They ballooned from about 6% of TSMC's revenue just a couple of years ago to an estimated 10 to 15% today. And this demand, it's laser-focused on TSMC's most advanced and most expensive manufacturing nodes, like 5, 4, and the new 3-nanometer processes. That gives a massive boost to both revenue and profit.
Now, a crucial and often overlooked part of this story is advanced packaging. The unbelievable performance of modern AI accelerators like Nvidia's H100 isn't just about the GPU itself, it depends on this technology called CoWoS. Think of it like a high-tech connector that lets a super powerful GPU sit right next to stacks of high-bandwidth memory. This is absolutely essential for crunching the massive AI models that power things like ChatGPT. Without CoWoS, the GPU would just be starved for data. It's not just a final step, it's a core enabling technology.
So this intense industry-wide demand for CoWoS created a massive supply bottleneck. You had every major AI player from Nvidia to Google desperate for this technology, and TSMC's capacity became the critical choke point for the entire industry. Well, basic economics tells you what happens next. That scarcity gave TSMC immense pricing power. The company has reportedly been able to raise CoWoS prices by around 20%, creating a highly profitable second revenue stream right on top of its already premium wafer sales.
This fundamental shift in both where the demand is coming from and the pricing power they have has profound implications for TSMC's entire financial structure. It is changing the company's profitability and its investment strategy for years to come. Let's see how.
Looking at the financials, we've seen this sharp V-shaped recovery in gross margins. After dipping during the semiconductor downturn in 2023, margins have just snapped back into that coveted mid to high 50s range. And this isn't an accident. It's a direct result of their advanced factories running at super high utilization rates and that much richer product mix, which includes both those premium AI wafers and the high-margin advanced packaging revenue we just talked about.
So, to meet this incredible wave of demand, TSMC is right in the middle of a CapEx super cycle. The company is investing at a staggering run rate of around $40 billion annually. To put that into perspective, that's more than the entire annual revenue of many large corporations. This massive spending isn't just about maintaining a lead. It's a strategic move to aggressively build out capacity for their next-gen 3nm and 2nm nodes, and of course, the advanced packaging facilities needed to lock in this AI growth for years to come.
But here's an important headwind to consider that makes these numbers even more impressive. This high level of profitability is being achieved despite the higher costs of building new fabs outside of Taiwan. This strategic overseas expansion in places like the US and Japan, it creates a drag of about 1 to 2 percentage points on their gross margins every year. So the fact that they can absorb those costs and still post margins in the high 50s, well, that just speaks volumes about how profitable their core AI business really is.
Okay, so with all that as our context, now we can look forward and start to evaluate the potential paths for TSMC through 2028. We're going to consider 3 distinct scenarios just to frame the range of possible outcomes for investors.
And this table here lays out the range of outcomes pretty brilliantly. Our base case, which feels like the most probable path, assumes a healthy 8% compound annual revenue growth through 2028, with AI demand normalizing a bit and gross margins stabilizing around a very strong 55%. The bull case, well, that envisions a world where this explosive AI demand just keeps going, keeping capacity tight and letting TSMC maintain its pricing power, pushing margins back toward the high 50s. And then there's the bear case, which reflects a potential pause in AI investment, a sort of digestion phase that would lead to lower factory use and pressure margins down toward 50%.
Of course, a thorough analysis means you have to have a clear-eyed view of the risks. There are several factors out there that could absolutely challenge this growth thesis, and as investors, we need to be watching them very closely.
The most significant cyclical risk is a potential digestion phase in AI spending, where cloud providers just pause to absorb the massive capacity they've just built out. Geopolitical tensions around Taiwan, well, they remain a persistent, low probability but high impact risk that's always kind of priced into the stock. We also have to watch customer concentration. With Apple and Nvidia making up such a huge slice of the pie, any issue with either of them could have an outsized impact. And finally, you always have execution risk on future tech. Any delay or yield problem on the 2nm node could open the door for competitors. And while TSMC holds a commanding lead right now, we absolutely cannot ignore the competition. Both Samsung and Intel are investing billions of dollars to catch up, and they are hungry. They're pushing their own aggressive roadmaps for 2nm tech, and they're building out their own advanced packaging capabilities. Their stated goal is to win back market share, and they might try to do it with competitive pricing to lure some customers away. This is a long-term risk we have to watch as we head into that 2026-2027 timeframe. All right, so putting all of this together, what's the crucial point for investors? What is the core thesis that really emerges from all this analysis?
The core thesis is this. This quarter's performance isn't just a cyclical upswing. The AI boom has fundamentally and structurally transformed TSMC's business. It has pivoted the company from relying on the often volatile consumer smartphone cycle to becoming the primary, indispensable engine for the durable, multi-year build-out of the world's entire AI infrastructure. That just makes the business inherently more stable and predictable.
Looking ahead, here are the key catalysts you'll want to watch to either confirm or challenge this thesis. The next earnings call in January is critical. We'll get the 2026 CapEx guidance, which will tell us how the company sees demand shaping up. Major new AI product launches from Nvidia and AMD in mid-2026 will signal the next wave of demand. And of course, the ongoing monthly sales reports and any updates on expanding packaging capacity, those are going to be your most real-time indicators of business momentum.
So we'll leave you with this final thought. TSMC has successfully navigated a huge strategic transition. With AI now serving as its new rock-solid foundation, this recent surge in growth, well, it may not be a peak,
but actually the beginning of a new, sustained era of dominance. What do you think? Let us know down in the comments. Thanks for watching The Chip Market. To continue investing smarter in the world of chips, be sure to like this video, share it, and, of course, subscribe to the channel for more analysis of the semiconductor space.